Hello. Today let's look at market hours. All right. So we have three trading sessions. We have the Asian session, the London session, and the New York session. So which currency pair do you think falls under the Asia? I would say the Japanese yen, right? And the London pound, right? And the New York, you have the US dollar. So now, what are we trying to get at? We want to know the best trading times, right? When is the best time to actually trade? So with that, we look at the opening and the closing for each session. All right. So we begin with the Asian session. Now I am using GMT here. All right, GMT. So wherever you are, you can actually use your time zone to actually correlate with this GMT here. So the Asia opens from 1 a.m. to 9 a.m. GMT. London opens from 8 a.m. to 5 p.m. And then New York opens from 1 p.m. to 10 p.m. All right, now we now look at the overlap with the Asia and the London. Which times do both of them run at the same time? Asia and the London, that is 8 a.m. and then 9 a.m. So that's the overlap for Asia plus London. How about London and New York, which is 1 p.m. to 5 p.m.? All right. So now our best trading time is during these overlaps, which is from 8 a.m. to 5 p.m. I hope this helps. So 8 a.m. to 5 p.m. GMT is the best time to actually trade. Now, the next thing we want to look at is kinds of Forex traders. So at the end of this, I want everyone to pick what kind of trader they want to be based on explanations I give. Now, the first one, we call them the scalpers. They target 5 to 10 pips per trade, and they need to make their profits within seconds to minutes. And they use the 1 minute and 5 minute charts. All right. Now, day traders, they target 20 to 40 pips per trade, and they need to reach their targets within a day. All right. They trade with a 15 minutes, 1 hour, and then 4 hour time frame. The third is the swing traders. They target 50 to 100 pips per trade, and they need to make their targets less than a week. And they analyze on the 1 hour and the 4 hour time frame. Position traders, they target 500 to 5,000 pips per trade. And it takes them weeks to months to actually make this target. And they trade on the daily and then the weekly time frame. Now remember when we calculated for pips, remember the lots, standard lots, mini lots, and the micro lots. So I am a day trader and a swing trader. I don't mostly swing, right? If it comes, I just take it. So as a day trader, 20 to 40 pips on a standard lot, right? Let's say one standard lot, that should be $200 to $400 per trade. And I need to make that within a day. All right. A mini lot, that should give you $20 to $40 per trade. And you give yourself within a day to make it. All right. So this is the meaning. So go through these. Let me know what kind of trader you want to be under the comments. I hope this actually helped. On to the next session. What is up, guys? This is Sam Kwekul of Tea. Today I'm going to introduce you to candlesticks. All right, we'll look at the history, we'll look at the fundamentals, And then we look at the candlestick charts, actually how to read and analyze the charts. All right, so the history of Japanese candlesticks. This, you just have to know the history. I mean, it's not really compulsory as a trader, but for those, who are kind of want to know how this all came about, you can actually check the history of Japanese candlesticks. So this is the inventor, Munihisa Homa, the most successful trader in history. All right, so he invented Japanese candlesticks. You can actually make some time to actually read on it. All right, so I'm just gonna skip this. All right, now we come to the fundamentals of candlesticks. The candlestick chart helps traders to easily determine price movements based on historic patterns. It shows the open, the high, the low, and the close. All right, so take note of this. The open, high, low, close, OHLC, of price in a specific given time. All right, so you can actually trade on any time frame you want. So let's say I'm trading on a 15-minute time frame. What that means is that every 15 minutes, a new set of candlestick actually opens. Okay, now there are two candles that form the candlestick patterns. We have the bull candle and then the bear candle. All right. So, Forex, price either goes up or down or sideways, right? If price goes up, we buy. No, if price goes up, we term that as a bullish trend. Now, how do we come up? How do we come about the name bull, right? So we need to look at how the animal bull attacks. How do they attack? Right, with their horn, and then they kind of, just throw you up. All right. So that swing movement from down to up is the bull. So anytime you hear bull in Forex, it means up, right? Uptrend. And the bear, how do a bears attack, right? With their paws, and then they kind of strike you down, right? So anytime you hear bearish trend, it means price is moving to the downside. Anytime you hear bullish trend, price is moving to the upside. So yeah. Now, fundamentals of the candlesticks, it's made out of two things actually: the body and the wick or shadow. Right. As time goes on, we will get to understand this. The body of the candlestick is a rectangle which marks the open and the close of price. Now, the wick is a vertical line that appears on top and below the body. It represents the high price and low price. Let me bring it back here. I said candlestick shows you the open, the high, the low, and the close, right? The body of the candlestick marks the open and the close, whilst the wick or the shadow marks the high and the low. So now, welcome to the Forex board. Dinner with candles, we don't mean going out with on a date, right? Going out on a date, having, candles set up and enjoying, right? Now, as a Forex trader, dinner with candles, this is what we mean. You can see the photo beneath it, right? Chart is running. He has his meal looking at the chart. All right. So I think by now you should be familiar with these Forex terms, right? Lot pips. Now, bullish candlestick mostly represent bullish by green, bearish by red. Bullish, it means prices to the upside. Now, for bullish, right? This is the open. We said a candlestick. Now, remember, candlestick is this rectangular thing. For the green one, the bullish, open is at this place, low, this vertical line beneath it, high, the vertical line above it, and then the close, this candlestick body. Bearish is the opposite, the open here, high, this vertical line here, down here, low, this vertical line, and then the close here. Now, if the close is above the open, then the candlestick is bullish, which means that the market is trending up. All right. If the close is below the open, it depicts a bearish trend, right? This indicates that the market is at a period of time. The market at that period of time is having a downtrend. All right, now let's look at the candlestick formation. All right, so we have the open, we have the low, and because price went down, it leaves a vertical line, which you can see here. And then we have the high, which price shoots up. And then finally, we have the close, right? Price drops. So now you see the vertical line here should depict that at some point, price went down. All right, that's why I left this vertical line here. You see the vertical line on top means at some point, price was extremely high here, but closed here. That's how come you have this. Now we look at the bearish candlestick formation. The open is here. So you have the high, you have the low. Because it went high, it left this stick here, the candlestick, this wick or shadow here, low, and then finally the close. This is the bearish candlestick formation. All right. Now, I actually released the book Becoming a Professional Forex Trader. It has more content in it, but I believe as a beginner, what we've covered so far should actually help you understand the basics of Forex, understand the Forex language, know the market hours, and now you are aware of candlesticks, the formation, and how to read it. All right. Hope this actually helps you in your Forex journey. And you can advance to the professional, which actually talks about strategies to use to trade, and how to set up your trading account and all that. All right. So thank you for your time. Now, kindly go through, and then we can proceed to the advanced lessons. What is up, guys? Today we are going to look at risk management. Right. We look at risk control, position sizing, risk versus reward ratio, and then building my strategy. All right, now risk control, position sizing, and risk versus reward ratio. Risk management talks about measures devised by traders to protect their accounts, right? That is minimize losses. So with this said, there is no way you can trade without actually incurring some losses, right? But a good trader must devise some ways to protect their accounts, right? To minimize those losses and make significant profit over time, right? Now, for you to protect your account, you must know, number one, how much to risk at any given trade. Number two, your stop loss and your take profit. Number three, your risk versus reward ratio. And then how to determine your lot size. So let's take a few examples: position sizing and risk versus reward ratio. Now, to understand risk management, let's take a look at this example. I have $100. I've deposited $100, and I want to risk 2% of my account size. That's $2. So any given trade, I'm willing to risk $2. My stop loss is at 20 pips. Risk versus reward ratio is 1:2. So what will be my take profit? Risk reward ratio is 1:2 means if I'm risking $20, my potential profit should be times 2 of it, which is $40. All right. Now, stop loss divided by your lot size, right? You should be able to know which kind of lot size to use. So this, I'll say it's an error. On an account balance of $100, you should be looking at trading with micro lot, which is 0.01 to 0.09. All right. So that's, you'll be using a lot of 0.01 per trade. All right. So stop loss at 20 pips, that should be $2, right? If you are using the 0.01 lot, $2. So this is how you actually know which kind of lot size you use per trade. Your stop loss must be fixed. Your take profits must be times 2 of your stop loss. All right. Now, same example, account balance of $1,000. Now with this, you can actually use mini lot 0.01. No, sorry, 0.1. Risk versus reward ratio, 1:3. So if I'm risking 20 pips on a trade, I want my potential profit to be 60 pips. All right. Lot mini. So now I'd want you to make this calculation, risk divided by the stop loss you want to use, and comment which kind of lot size you'll be trading with. Same thing for account balance of $10,000. This you can trade with mini lot, maybe 0.5. You can trade with standard lot 1. All right. So you do the same calculations, and with that, you will be able to know, okay, if I want to risk 2% of my account balance, this is the kind of lot size I should use. This is where I need to set my stop loss. All right. So this, you actually be under a risk control. You wouldn't risk over 2% of your account balance on any given trade. Now, building my strategy, the advanced lessons will actually, I trade demand and supply, so that's what I'll be doing. So now, as a beginner, this is your last thing to do. You take a pen and paper. What type of trader do you want to be? We looked at scalper, day trader, swing, position trader. Which kind of trader do you want to be? What's your risk to reward ratio? Range of pips you want to make. This should depend on the type of trader. Now, trades to take per day. Which charts are you going to analyze on? And what's your favorite pairs? Now, as a trader, you must backtest often. Go back to historical data and apply trading idea. All right. So building my strategy, I would like you to comment which type of trader you want to be, the risk reward ratio, range of pips you want to make, trades to take per day. Now charts, 15 minutes, 1 hour, 4 hours, and then your favorite pairs. All right. So thank you so much for your time. Hope this helped. All right. So we meet. Bye.